Hello and welcome to the Forma Models Property Manager Business Plan with Return Calculations. This model can be used to analyze the financial return of acquiring an existing property management company through merger or acquisition, operating an existing property management company, or starting a new property management company using a three-statement model. The Pro Forma tab includes all assumption inputs as well as the calculations for the sources and uses, returns, annual valuation, income statement, balance sheet, and statement of cash flows. The model is dynamic for up to a 5-year valuation period for returns and allows for a variety of debt and equity assumptions, including the ability to buy back or issue debt or equity throughout the business hold period. The Output tab provides print-ready formatted reports of key metrics and indicators, which can be used with investors and lenders as an investment and business plan supplement. The README tab states the model purpose, highlights common use cases, and provides an overview of functionality, formatting, and all of the unique modules within the model. This tab also provides additional documentation, contact information, and a summary of additional products and services available from Pro Forma Models to support your analysis needs. Let's start this model walkthrough at the Monthly Pro Forma tab. The Monthly Pro Forma includes all assumption inputs as well as the calculations for the income statement, balance sheet, and statement of cash flows. Cell G7 contains a date input to start your analysis. The revenue model calculates monthly income based on the number of units under management and the average monthly management fee. There is a units under management schedule consisting of starting units under management, additional units brought under management in the month, and the ending units under management. There is a revenue growth escalator assumption to grow the average fee per unit annually. There is also an input available for other income, which could be for income derived from leasing fees, project management fees, or other additional and ancillary services provided by your company. Payroll expenses can make up a substantial portion of operating expenses. Due to their large expense burden, corporations at times will employ dynamic staffing models with staff working seasonally or only hiring people once certain metrics, such as a sales or profit target, are met. The Pro Forma Models business plan has a complex and dynamic payroll module allowing for a variety of different staffing programs. The position name is entered in column B. The start date of employment is entered in column C. The number entered in the column relates to the model month number. For example, month 1 will be the first month of the model and month 12 will be the 12th month of the model. If you want a position's employment to begin in the first month of the forecast, enter 1 as the start month. The end date of employment for model purposes is entered in column D, similar to the start month. The end month relates to the model month number. For example, if you want to model an employee for the entire 5-year analysis period, enter the end month as 60. If you wanted to hire a position for a project in year 3, but won't need the position beyond year 3, you can enter the start month as 25 and the end month as 36. Payroll burden is for overhead related to payroll expenses, such as payroll taxes and benefits. The payroll burden figure is entered in cell F30. An annual payroll inflation assumption is entered in F31 to account for annual labor expense growth. If it is applicable to your analysis, vehicle expenses for the owner and employees are modeled in a similar fashion as salaries to include the costs in your model. The model is robust and can handle owned or rented real estate within the analysis. The next section is for real estate expenses. Some of the inputs are only applicable if you are renting facilities, some inputs are only applicable if you are purchasing your facilities, and others are applicable in both rent and own situations. For example, if you own your facility, you will have to pay real estate taxes, but you may not have to pay real estate taxes as a renter. The inputs in this section can be used at your discretion as they are applicable to your specific situation. If you are purchasing facilities within the acquisition, inputs are available further into the model to account for equity contributions and debt service related to real estate. The final section of assumptions before we complete the income statement inputs is for selling, general, and administrative costs. This section contains inputs for typical selling, general, and administrative expenses such as insurance, advertising, information technology, and bad debt expense. Following the format of previous expense sections, an annual selling, general, and administrative expense inflation factor input is also included. With these assumptions completed, the income statement will begin populating in a neatly organized and logical format. Gross profits for the property management business will consist of management fee income as well as other income. Property management businesses typically do not report a cost of goods sold. This leads to a 100% gross profit margin. Total operating expenses are consolidated and then deducted from gross profit to generate the monthly earnings before interest, taxes, depreciation, and amortization. The monthly earnings before interest, taxes, depreciation, and amortization is complemented by a calculation of the monthly earnings before interest, taxes, depreciation, and amortization margin. The earnings before interest, taxes, depreciation, and amortization is followed by depreciation and amortization deductions. Depreciation is split out in the model to segregate depreciation for the business acquisition if you are acquiring through an asset purchase, real estate depreciation if you are buying a facility in the transaction, and general capital expense depreciation. Depreciation expenses are deducted to calculate the monthly earnings before interest and taxes. A calculation of the earnings before interest and taxes margin is also included within the income statement. Interest expense is segregated by interest on real estate debt if you are buying a facility and interest on the business acquisition. Interest expenses are deducted to calculate the earnings before taxes. Taxes are then deducted to determine the monthly net earnings and net margin. The days of sales outstanding, used to calculate accounts receivables, and the days of payables outstanding, used to calculate accounts payable are entered next. These are key inputs that impact the balance sheet as well as working capital, which impacts the statement of cash flows. The next section of the model calculates and summarized the monthly depreciation expense for capital assets. The schedule begins with 4 consolidation sections for total depreciation, business acquisition depreciation, real estate depreciation, and capital expenditure depreciation. The depreciable asset schedule handles inputs as the item label in column B, the date of acquisition in column C, the expense in column D, the number of months to depreciate the expense over in column E, and the category selection, meaning if the item is real estate or business acquisition related, or general capital expenditures. The columns to the right calculate the monthly depreciation by item depending on the applicable months of depreciation you input for the specific item. Please note that all pro forma models contain a dynamic header, which is a useful tool to keep high impact and important information always available and visible to you throughout your analysis. This model's header contains a summary of the purchase price and capital stack as well the internal rate of return and multiple of capital on an unlevered and levered investment basis. At this stage in the modeling process, the balance sheet will begin to populate. Please note that pro forma models never utilizes plugs within our financial models. This means that all items flow through each of the 3 statements through the use of supporting schedules rather than utilizing accounts to force balance the statements. This leads to enhanced accuracy and credibility. The balance sheet models assets split into current and non-current assets. Liabilities are also modeled as current and non-current liabilities and includes any applicable debt used as part of the transaction you are analyzing. The balance sheet concludes with the equity accounts. Following the accounting equation that assets need to be equal to liabilities plus shareholders' equity, a check is worked into the balance sheet to ensure the accounting equation holds true. The next section contains the real estate debt schedule, which is applicable to your analysis if you are buying real estate as part of the transaction. Sometimes when you are buying a business, the owner wants to dispose of their office, warehouse, or retail stores with one sale. If your analysis involves buying real estate, this section applies to you. If you are renting real estate and not buying, then you can skip this section. If you are buying real estate with the business, the purchase price attributable to the real estate is entered in cell D178. The closing costs as a percentage of the purchase price are then entered in cell C179 to calculate the total cost basis of the real estate. If you are using debt to purchase the real estate, this section includes the inputs for loan to value, interest rate, and amortization term. The monthly debt schedule follows this section, including the ability to model prepayments in row 190 if you want to accelerate debt reduction and your loan allows. Next up is the business acquisition debt schedule, which is in a similar format to the real estate section we just reviewed. The model begins by calculating the year 1 annual earnings before interest, taxes, depreciation, and amortization. The acquisition multiple is entered into cell C195 to generate the business value in cell D196. The closing costs as a percentage of the business value are entered into cell C197 to calculate the total cost basis of the business acquisition. If you are using debt to fund the acquisition, assumptions will be input here for loan to value, amortization term, and the interest rate. A debt schedule is calculated in this section, breaking out the total monthly payment, the principal component, and the interest component. Similar to the real estate section, prepayments can be entered in row 208 if you want to accelerate debt reduction and your loan allows. Please note, this section only needs to be used if you are buying a business. If you are utilizing this model to forecast the financial performance of an existing business, please set all inputs to 0 as they will not apply to your use case. A cash flow statement is presented next, which begins with a calculation of the monthly changes in net working capital. The cash flow statement is organized in an industry standard format with cash flows broken out by operating, investing, and financing activities. The cash flow statement concludes with a calculation of the monthly incremental cash flow as well as the monthly beginning and ending cash balance. This is incredibly useful for risk management, understanding run rate, and the ability to invest further in the business or pay down debt. The three-statement financial model is now complete, and we can begin analyzing the returns from the business acquisition. The sources and uses are presented to understand the total capital needed for the acquisition as well as where the money is coming from to fund the investment. Next, we will review the returns in 4 different ways on a levered and unlevered basis as well as through the lens of an owner-operator taking a salary as well as a passive owner-investor. The first return section is from the perspective of an investor-owner not taking a salary on an unlevered basis. Inputs are included in this section that are then applied to all other return analysis. The first assumption is for the business disposition multiple in cell D257. This assumption will generate the disposition value by multiplying the annual earnings before interest, taxes, depreciation, and amortization by the multiple assumption. The business disposition closing costs assumption as a percentage of disposition value is input in cell D258. The real estate disposition value is generated as an annual appreciation applied to the acquisition price. This assumption is entered in cell D259. The real estate disposition closing costs as a percentage of the disposition value are entered in cell D260. The returns table consolidates applicable line items to generate the unlevered net cash flow, internal rate of return, and multiple of capital. The returns presented in the first table are on an unlevered basis from the perspective of an investor-owner not taking a salary from operating the business. All of the following returns tables will utilize the disposition values and closing costs generated in the first table. The next returns table consolidates applicable line items to generate the levered net cash flow, internal rate of return, and multiple of capital. The returns presented in the first table are on a levered basis from the perspective of an investor-owner not taking a salary from operating the business. The 2 next return calculations display results for an owner-operator taking a salary while owning and operating the business. One additional assumption can be used, which is an input for the owner's income tax rate, if you want to look at the net cash flow after tax for the owner's salary compensation. The returns table consolidates applicable line items to generate the unlevered net cash flow, internal rate of return, and multiple of capital. The returns presented in the first table are on an unlevered basis from the perspective of an owner-operator taking a salary from operating the business. The final returns table consolidates applicable line items to generate the levered net cash flow, internal rate of return, and multiple of capital. The returns presented in the last table are on a levered basis from the perspective of an owner-operator taking a salary from operating the business. The Output tab contains a print-ready, pre-formatted, and neatly organized report consolidating the detailed pro forma into an easy-to-understand executive summary that can be presented to investors and lenders as well as included in business plans and pitch presentations. The top of the report consolidates the investment assumptions, cost basis, and capital structure for the business acquisition as well as the real estate purchase, if applicable. The sources and uses are presented next to clearly communicate what is being acquired and how it is being financed. The sources and uses table is supplemented by a pie chart showing the breakdown of investment in the business and real estate as well as a bar chart of the capital structure on acquisition. The returns are then highlighted in an easy-to-communicate matrix with the return type, such as levered or unlevered and owner-operator or investor-owner perspective, as the rows and internal rate of return and multiple of capital as the columns. To illustrate the return, a dual-axis chart is provided showing the internal rate of return and multiple of capital by category. The executive summary concludes by showcasing the operating highlights based on key operating metrics from the income statement, balance sheet, and statement of cash flows. Key metrics include various operating margins, days of sales and payables outstanding, and incremental net cash flow generates. Thank you for tuning in. We hope you enjoyed this Pro Forma Models walkthrough and encourage you to visit our website to try the model for yourself.